but appreciate that. So for those of you that don't know me, I'm Bob Goggin. I'm the Chairman and Chief Executive Officer of the bank. And on behalf of the Board of Directors, I want to welcome you to the 191st annual meeting of the Hingham Institution for Savings. This is our 35th anniversary of our initial meeting as a publicly traded company. We're going to conduct this meeting again this year in person and via Google Meet. So I think we've got an equally significant attendance online following along on Google Meet with us today. We have with us all of the members of our Board of Directors today. We also have a few other folks that I should introduce. First, Arthur Reagan of Reagan Associates. They have been designated by our board as Inspector of Elections again this year. So thank you, Arthur. We also have with us Marty Kane and Molly Ebert from our CPA firm, Wolf & Company. So if you have any really tough questions, you can ask them how they're doing. So today we're going to again conduct the meeting in two parts. First, the formal portion of the meeting that involves those 5 proposals that are set forth in our notice of meeting, proxy statement. And after we have dealt with the formal portion of the meeting, we will adjourn that, and we will move on to a presentation from our President, Patrick, with regard to the activities of the bank this past year. And after that presentation, Patrick and I will be available here and to respond to questions. We've received a number of questions digitally, and we'll go through those first, and then we'll take questions from the floor. So a few housekeeping items. First, this meeting is being recorded. Second, all of the Google Meet attendees are attending in listen-only mode. Third, as noted in our proxy materials, all voting is done either in person or by proxy. Electronic voting is not available. Fourth, I would remind myself to silence my cell phone, which I think I've done. Let me see. I have. And lastly, I want to draw your attention to the safe harbor statement here somewhere. Someone just did that because this isn't working. Okay. That's the so-called, I call it the corporate Miranda warning that, that we have. So with that, we will proceed with the formal portion of the meeting. It should be noted that I've received an affidavit certifying that the notice of the annual meeting and proxy statement was sent to all stockholders as a record March 3rd and were mailed on March 10th. And I will inquire as to whether there's any shareholder present that wants to vote in person. If so, Mr. Reagan will give you a ballot. I assume everyone's already voted. Okay, very good. No one there. So at this point, I'm going to call on Mr. Reagan to furnish us with a count of the shares present personally or by proxy.
Mr. Chairman, on this very pleasant last Wednesday in April, there are at least 1,898,480 shares present either in person or by proxy.
That being the case, I will declare that a quorum is present, and the first matter to be voted on by the stockholders is the election of directors. The nominees for election to 5 Class 1 director seats for 3-year terms are as follows: Ronald Falcione, Kevin Goggin Jr., Julio Hernando, Ryan T. Joyce, and Robert K. Sheridan. Do I hear a motion that the nominees be elected as directors of the bank to serve until the expiration of their respective terms and until their successors are duly qualified.
So moved. Second.
Having received that motion, is there any discussion on that motion? Anything at all? No? Given that fact, we'll now proceed to a vote, and I'll call upon Mr. Reagan to announce that vote.
Mr. Chairman, each nominee for director received at least 1,118,263 shares voting for their election, which is in excess of both the majority of the outstanding shares and a plurality.
The holders of a plurality of the shares present are represented and entitled to vote at the meeting, having voted for the nominees. I hereby declare them to have been elected. Next matter to be voted on by the shareholders is the election of Mrs. Jacqueline Youngworth as clerk of the bank to serve until the year 2026 annual meeting and until her successor is duly elected and qualified. Is there a motion to that effect?
So moved. Second.
Is there any discussion of that motion? Motion having been made and seconded, I'll call upon Mr. Reagan to announce the vote.
Mr. Chairman, our Jackie Youngworth received an impressive 1,477,045 shares voting for her election as clerk of the bank, which represents 98.96% of the shares voting on the matter. Outstanding.
Great job, Jackie. All shareholders present having been given the opportunity to vote, I will declare Mrs. Youngworth again elected as clerk of the corporation. The next item of business is the so-called say-on-pay resolution. The proposal calls for an advisory vote on the approval of executive compensation. So do I hear a motion to approve the compensation of the company's named executive officers as disclosed pursuant to the Securities and Exchange Commission's compensation disclosure rule?
So moved. Second.
Having been moved and seconded, is there any discussion on this motion? Any at all? Hearing none, I'll call upon Mr. Reagan to announce the vote.
Mr. Chairman, at least 1,166,898 shares voted to approve the bank's named executive officer compensation, which is in excess of both a majority of the outstanding shares and a plurality.
Thank you, Arthur. The holders of a plurality of the shares present are represented and entitled to vote. Having voted in favor, I will declare that motion as carried. Next item for consideration involves the vote on the future frequency of say-on-pay votes. As you know, shareholders can decide whether to have that done annually or to do it up to, I think it's the requirement is a minimum of every 3 years. The board has recommended that we do that every year. We believe that it is in the best interest of shareholders to have regular annual input on that if they so wish. So the next item for consideration is the board's recommendation that that frequency be established as an annual frequency. Do I hear a motion to that effect?
So moved. Second.
Moved and seconded. Any discussion of the motion? Hearing none, I'll call upon Mr. Reagan to announce that vote.
Mr. Chairman, at least 1,326,180 shares voted to have the so-called say-on-pay votes occur each and every year. That number is in excess of both the majority of the outstanding shares and a plurality.
That vote having received a plurality of the votes, I will declare the same as having been approved. Next item, and the final item to be acted on by shareholders, is to ratify on an advisory basis the appointment of Wolf & Company, PC as the bank's independent registered public accounting firm. Do I hear a motion to approve the appointment of Wolf & Company as the bank's independent registered public accounting firm?
Second.
Having been moved and seconded, any discussion on that motion? Any discussion at all? Hearing none, I'll call upon Arthur to announce that vote.
Mr. Chairman, at least 1,889,610 shares voted for the appointment of Wolf & Co. as the bank's independent auditors. That number is also in excess of both the majority of the outstanding shares and a plurality.
That motion having received a plurality of the shares, I will declare the same to have been adopted. Before we move to adjourn the formal portion and we move to Patrick's presentation, I'd like to say a couple of words with regard to the way we've opened this meeting for 32 years. In the beginning of the meeting, I have without fail recited the rich annual meeting this is. So this year, this is our 191st annual meeting, our 35th as a publicly traded company. And this year, it really, that history really did strike me in a sense that when you think about this bank and you think about this organization, we have survived and prospered through civil wars, world wars, Great Depressions, Great Recessions, smaller wars, smaller recessions, smaller depressions. And we've done that with tremendous durability and resilience. And this year, as we emerge from an historically challenging period of interest rate increases and yield curve inversion, I'm reminded of that durability and that resilience. And I want to thank all of our colleagues, our president, and our board for their efforts and their stewardship of this institution and for their contributions to that resilience that we have again shown. So with that, as there are no further business to come before the meeting, in the formal portion of the meeting, I would like to hear a motion to adjourn.
So moved.
Moved and seconded. All in favor, say aye.
Aye.
Opposed, no. So voted. Thank you very much. Patrick.
Thank you. So before I launch into it, Dan and Kayla in the back, is this volume okay? Okay. So I have gotten some feedback in prior years that I do not project or speak loudly enough, and I'm trying to take that on board. First, thank you to the Board of Directors. As my dad said, everyone's here today, all of our colleagues that are here. In particular, I wanted to thank Kayla and Dan and Caitlin and Mike and Adam. So Kayla, our Chief Marketing Officer, Dan, our CIO, Adam, Caitlin, and Mike are all in our IT group for helping put this together. Lucy Romanowitz, where is Lucy? Is behind John Louderhan. Thank you for your hard work. Linda Roy as well. We, like my dad said, have been doing this for 35 years, a public company, with, I think, 2 exceptions. We have always done it here. One being the meeting at South Shore Country Club, which we have never gone back to after getting control of the bank in '93. And the other was, I believe, in 2016 or 17, at the Old Ship Church, which is a couple hundred yards this way. And we did that because the Hingham Historical Society was renovating this building, so it wasn't available to us. But I recite that because we do the meeting every year, and it can be easy to take for granted the work that those folks put into to pulling this off, both in terms of the space and in terms of the technology component. So I wanted to express my appreciation to them. I also feel badly, we have some folks that help out on AV, and I actually don't know the 2 of your names. Ariel and Roger, thank you for your help. With that, I want to launch into the substance. The format is the same as the prior years. First, financial results. for 2024, and we're going to touch on the first quarter of this year a little bit, the operating highlights, and then finally questions. Somewhat fewer questions this year than last year, but we also have folks in the room that I know have questions and are interested and engaged with the business of the bank. So we'll probably alternate back and forth until we run out of time. I would just say before we get to that point, please make them difficult. This has been the front of the slide deck for a number of years. Banking is a very good business unless you do dumb things. Warren Buffett with 2 T's. It is a true statement, as I think we've talked about in some recent years. It is possible to do dumb things. No one is immune from that. I certainly have done some of those. But the core elements of the business, which make it an attractive one, I think are still present. So I think there's still a great deal of truth here, and it's helpful to remind ourselves of this. 2 slides, again, that we cover every year. And it's interesting, particularly in our conversations with bankers that are considering joining Hingham, that have watched videos of prior annual meetings. These 2 slides are the 2 slides that are most often referenced in the conversations that we have with them. And I think that's because there is a simplicity to our business, and the explicitness with which we define the things that we don't do is important, and it resonates with good bankers. It resonates with bankers that have a clear idea of what they want to do for clients, and a clear idea of what they don't want to do or where they don't think that banks often add value. So first, what we do, commercial and personal deposit banking, commercial real estate lending, which, as everyone here I think understands, but is worth repeating for us, is primarily multifamily lending or lending on property where there are people living in it. And that ranges from 5+ unit apartment buildings. That could be 200 units, it could be 100 units, it could be a triple decker in Dorchester or Somerville. It could be apartments in the city that have ground floor retail or office in them. Most of what we do on the commercial real estate side, someone lives in. And then finally, residential real estate lending. And for us, this is value add for our clients. So this is lending that solves a problem that they have. It's often non-conforming. It's often lending to our existing customers in our client base, whether they're commercial real estate customers or perhaps nonprofits or other institutional customers in the deposit side. But it's not a garden variety conforming loan that you could walk into any bank and get. It's something that we need to do for them that delivers some special value. We need to solve a problem they can't get solved somewhere else. What we don't do, I won't read the whole list off. It's basically everything else in the universe, and we group it into a couple of things. C&I lending in all of its varieties, we don't do. I think we have a limited number of C&I loans that we have with some nonprofit customers, a school, another local nonprofit, but you could count them on one hand, and they're less than $1 million. Consumer lending, again, this is a broken record for folks that have been at these meetings before or have heard me speak. If it moves, we don't lend on it. Cards, boats, auto, RV, personal lines, all of it. Investments we don't touch, insurance brokerage or underwriting we don't touch. Interestingly, a business that in recent years has changed in Massachusetts. In prior years, we've talked about how other community or somewhat larger banks have done very well at that. Eastern Bank in Massachusetts was a great example of that. They recently sold their insurance business. Secondary market residential, as I said, we don't sell our loans in the secondary market. Tax credits, solar, cannabis, crypto, and then finally participation. So I lied, I did read all of it. I apologize. Capital allocation, no changes from prior years. First, we're looking to invest organically in the balance sheet in growth in loans and deposits. Our view is that over a long period of time, that's where the most attractive returns are likely to be. There may be particular moments in time where returns are attractive elsewhere in the structure, but over 30 plus years, funding organic growth and reinvesting in the business has been the highest source of durable returns through time. Second, minority equity investments. We have a portfolio of equity investments, some public, some private, primarily in banks and financial services, but with some significant investments elsewhere. We like it for a variety of reasons. We don't pay control premia. We have liquidity. It generally is in a business that we think we can understand. It's either similar to or adjacent to the core operating business that we run. Third, dividends, both regular and over time special. As everyone knows, we did not pay a special last year. And then finally, repurchase, which is something that historically we have not done, but we discussed extensively last year. And I think going forward is something that is on the plate in a way that it has not been in the past. Not attractive acquisitions. So when we took control at Hingham 32 years ago, the balance sheet was about $140 million in size. And we're at about $4.5 billion now. As everyone knows, that was, well, everyone in the room, but perhaps others might not. That was 100% organic. So we've never bought another bank. We've never acquired branches from another bank. We've never done purchases of loan portfolios. But the key thing is that we really are not in the acquisitions business. And the reason for that is that over time, we are suspicious of its ability to add value for owners. And we are suspicious of the ability of banks to deliver better service to clients. And we generally have not found in studying acquisitions elsewhere that the opportunities that are created for our colleagues, for our staff, are good ones. So to the extent that it doesn't serve the owners, it doesn't serve the staff, and it doesn't serve the clients, one might be left wondering who does it serve. And generally speaking, our view is that that's management teams. And as we've discussed before, we, for better or for worse, manage the bank, but think of ourselves as owners first, and bankers second. So this remains as unattractive as it has in the past. 2024, the financial results. I think I've trimmed a couple of slides out of here, so it should go a little more quickly this year. There we go. 28.2 million in earnings for last year. Better than nothing, better than 2023. Not really satisfactory from our perspective in terms of the returns on equity that we've historically earned, which have been in the low to mid-teens over time. 2020 and 2021 were particularly exceptional years. In part because of the shape of the yield curve, in part because of the contribution from our investment operations. But one of the things that we talked about in April of last year and was the subject of, I think, a lot of discussion. Most of the questions in reviewing last year's questions really revolved around this, was at what point did we think that the shape of the yield curve would uninvert, or put differently, when did we think that the operations of the bank would start to return towards a more normalized level of earnings? And we absolutely hit that point last year, probably in first or second quarter. And from a trajectory perspective, The performance in the first quarter this year, I think, bore that out. We're going to get to it in a little bit. We've seen a substantial increase in the net interest margin, in the core operating earnings, which are the earnings that we normalize to remove any gains and losses from our securities, from our investment operations. So there really was a turn early last year. And to my dad's point, I think everyone in this room, all of our colleagues, deserve a great deal of credit for the work that we did to move through that period. I think it is also worth noting, these are GAAP earnings. So I should maybe stop because I'm presuming something. Generally accepted accounting principles require that we report both our core earnings from the bank and then any gains or losses on our investments, regardless of whether we sell them, which are referred to as unrealized gains. In the laser pointer won't work. In 2020 and in 2021, that substantially added to earnings. 2022, there were unrealized losses. 2023 and 2024, the investment operations helped us significantly through this period. So operating earnings in 2024 were somewhat weaker than this, but the portfolio was very helpful. I think it's important to be transparent about that. Return on shareholder equity. This goes to my point earlier. $28 million in earnings is nothing to sniff at, but on the other hand, what we're really looking at is what is the return on the equity that we've been entrusted by the owners to manage. And historically, that has been a low to mid-teens number, which is kind of a satisfactory one to us and at the top of the industry. In the last 2 years, so 2023 and 2024, in particular, that number has been somewhat lower. Remarkably, it compares favorably to savings banks here in Massachusetts. Although I don't know that makes me feel any better about my performance in that respect. Shareholder equity, book value per share. This is a key measure. This you'll find in our quarterly press releases. This is something I think quite a bit about, the 5-year compound annual growth rate in book value per share. So this is the total stock of equity in the bank divided by the number of shares outstanding. So there's a couple of things that impact this. One, what do we earn every year? So that's the core operating earnings. That's the investment gains or losses. 2, what do we return to the owners in dividends every year? And 3, what is the share count? And this is where the question of repurchases comes into play. This 5-year CAGR of 11.3% is actually very high for the industry. I think is probably still in the top decile. It might even be somewhat higher than that. It is fairly low for us. So if we were to look at the last 5 years, it probably would be the lowest. So some work to do here, but still comparatively not bad. Low-cost leadership, again, something we talk about every year. The efficiency ratio of over 60% looks positively astronomical if you follow our efficiency ratio over time. For the industry, it's probably right in the middle of the pack. In thinking about the efficiency ratio, it's influenced by 2 things. The numerator is the expenses of running the bank. So the cost of leasing this room today, the electricity in the building, our IT budget, our people, everything. The denominator for the efficiency ratio is net interest income and non-interest income combined. What this means is that the efficiency ratio is fairly sensitive to changes in net interest income or net interest margin, in percentage terms. So in the last 2 years, we've seen this rise quite a bit. The low 60s is very high for us. We pair that with another ratio that we've tracked over time that we've talked about, which is total operating expenses as a percentage of total average assets for the year at 67 basis points. This compares to an industry figure probably around 230, 240 basis points. And it gives a sense of what the structural efficiency is in the bank. And it's important when we think about the direction of the net interest margin as it was falling, as it troughed, and then as it's rising now. This really is a measure of how much of that increase in NIM we get to capture in the form of earnings. And the more efficient that we are, the more of that increase we capture. So in this respect, it's very, very positive. It's the product of two choices that we talk about every year. One is game selection, the other is game play. Game selection, which is the structural choice, is the question of what we do and what we don't do. The operational choice, or game play, is how we play. So how we deploy technology to take cost out, how we try to recruit and retain and develop higher quality bankers that can in turn attract and retain more profitable customers. That's really about play, not about selection. The top three words have stayed the same for a number of years. Astute observers will see that we actually did grow the loan book last year. It actually shrunk just a little bit. We had a decent year in terms of originations. We had some strong payoffs in our construction book, as well as in the perm book. But the loans that we made last year were good ones. And I don't think it's the case that this is necessarily going to grow every year. There was a bit of deleveraging in the balance sheet where we accumulated capital, and we replaced some wholesale funding with deposits, and we focused on making good loans. Net charge-offs. This is a tough slide for everybody to see in the room. If you've been able to bring it up on your phones using the QR code, it might be helpful. What we're looking at here is net charge-offs at Hingham and net charge-offs for all FDIC-insured banks. Step away from the microphone. That's what I thought. From 1994, so we extended this a little bit this year to capture the entire run that we've had here at Hingham. The blue bars are net charge-offs at all FDIC-insured banks for that year, and the red bars are the charge-offs at Hingham or the net recoveries. To stop for a moment, because I'm not sure that everyone necessarily understands what this is. A charge-off is essentially when we recognize that we have lost money on a given loan. Net charge-offs reflect two things. One, the loss, and two, the recovery, if we experience any of it. Does that sound right, Marty?
That's right.
Good. So what you can see here over time is that we have not been immune to credit issues, and we certainly have not been immune to losses. There are some years, particularly if you look in 2008, 9, 10, 11, where we peak, I think it's 7 basis points of net charge-offs in the midst of the great financial crisis. But it really pales in comparison to what we see in the industry. And so I think the point of emphasis here is that while it is certain that we have made mistakes and we will experience losses in the future, over time remaining focused on credit quality is critical, because net charge-offs really are the bank killer. Credit quality is the bank killer. There have in recent years been issues at First Republic or Silicon Valley or Silvergate that were primarily liquidity-driven and not credit-driven. But in looking back over long cycles, credit is the thing that I think about when I wake up, and it's the thing that I think about when I'm going to sleep, much to the chagrin of my wife who's here. Yep, there we go. Deposits, a somewhat lower 5-year CAGR. This masks what I think has been some really strong performance over the last year, both from our specialized deposit group and our retail banking group, in core relationship non-interest-bearing deposits. So although we have growth here, under the surface there's been a lot of remixing from higher cost time deposits into lower cost savings money market and most beneficially checking deposits, and particularly in the last year. Non-interest bearing deposits, this is the last 5 quarters, so this is essentially where we were a year ago when we met here. When we look back over the last year, I think it's 23% growth year over year in checking deposits. Again, driven in both SDG and the retail banking group, closing in on 100 million. And that growth accelerated in the first quarter of this year, so I think we're at 30% annualized. Really the product of the approach, personalized service, digital excellence, low or no fee, and the 2 engines that I've talked about. The specialized deposit group, very similar to what we talked about last year, but it's worth checking in and reminding folks what they do. This describes 2 pieces to the group internally. Lee, I apologize for pretending that about half of your team belongs here. But this is the customer-facing relationship managers and bankers that are developing new business with customers, existing and new prospects, as well as the team that supports them. So our cash management specialists that are working with those clients to open those accounts, get them set up, tear them down, switch signers, handle issues, really the full range of servicing issues that those clients have. For larger, more complex, service-intensive customers, that service model, that experience is something that's very, very valuable. They don't get it at larger banks. If they do get it, they often have to pay quite a bit by way of fees. So it's a model that we've had some success with and that we continue to invest in from a recruiting standpoint. That's true here in Boston. It's also true in Washington and in San Francisco. And we have Phil from San Francisco actually physically present here today. Thanks, Phil. Okay, first quarter, a couple things I wanted to touch on here. A loan growth, basically flat over a year ago. Some good, strong originations in the first quarter, paired with a lot of payoffs that we like to see in the construction book and the perm book, some of which are at fairly low rates, so we'll take them. Deposit growth, I think about 10% year over year, 9% year over year at the end of the first quarter. Really strong growth in checking deposits in the first quarter, 30% annualized. On the income statement, if we looked at the net interest margin in the first quarter of last year, it was about 84, 85 basis points, 150 in the first quarter of this year, exiting the quarter somewhat higher, as the assets mechanically reprice as we originate loans at higher pricing, as the funding costs fall. We continue to benefit from extraordinary efficiency in the bank. It really is a core part of what we're doing. And the investment portfolio contributed a little smidge in the first quarter. As we've talked about, that is composed of a number of holdings, many of which we've owned for over a decade now. And our approach is not a short-term one, and our expectation is that it contributes over time, but not necessarily in any given quarter. A couple of topics here that I wanted to talk about. Some of this we'll address in some of the questions. First, credit quality. And breaking it up into a couple of pieces, multifamily, Washington, San Francisco probably being the least germane to the conversation here. We still see in the markets that we're operating in a fair degree of health in the multifamily markets. Vacancy remains fairly low. Rent growth continues to be fairly strong in Boston, in Washington, and recently in San Francisco, which is a somewhat new development. And the reason for that, we talk about this a little bit in our filings, we've talked about this a little bit here, is that all three markets are fairly supply-constrained markets, which means that for a variety of reasons, whether it's the regulatory environment, whether it's the supply of raw land, it is somewhat difficult to create new multifamily supply in these markets. And what that means is that in pairing that with a relatively high level of demand, again, both three markets are affluent, urban, coastal, and there are some strong demand drivers, even, and we'll touch on this in some questions, even in Washington recently, you tend to see fairly steady low to mid-single digit growth in rents, which over long periods of time, from a lender perspective, is important. So in the multifamily market, I think we still see a fair degree of health. In terms of funding conditions, I talked a little bit about the stabilization of the margin, growth in checking deposits. Although we've repositioned the balance sheet in some ways, we still remain overwhelmingly liability sensitive. So our positioning is still for somewhat shorter term rates to fall. And finally, scaling SDG, and I talked about this a little bit before, investing in that team, continuing to recruit relationship managers, continuing to identify really talented cash management specialists that can work with that team to work with clients, and figuring out how we can find more customers that are a good fit for our model. We have a lot of business that we gather through referral. We have a lot of business that we have attracted through some forms of marketing, but we're continuing to try to figure out how to do that more effectively, in greater size and more efficiently. And then finally, I won't dwell on it, but process improvement and eliminating waste, this is simply something that goes on every year. And I don't really have anything new to report on that topic. That takes us to questions. And for that, I'm going to sit down. We can start from the prepared, or if someone in the room has something, we could start in the room and move to the prepared.
Anyone in the room with a question? Other than what? Yes, sir.
Can you elaborate how Doge is affecting the Washington model?
We stole like half the prepared questions.
Yes.
Yeah. This has been something that there has been, I would say, an increasing level of interest in over the last month or two. I'll probably equivocate a little bit, and then I'll share some firmer thoughts, which is I think it may be too early to tell. I think it's probably worth taking the question and breaking it into a couple of pieces. I think the first piece is what has Doge broadly defined said they plan to do with the federal workforce, with the office footprint for the federal government. I think a second question is, to what degree is that aspirational or rhetorical, and to what degree is it real? I think the third question is, to the extent that we believe that some portion of that is real, how does that impact what we do? So let me try and take those sort of three in sequence. What has been rhetorical or aspirational is obviously very expansive. It's a significant portion of the federal workforce. There is a fairly high concentration of either direct employees in the federal workforce in the DC area or indirect employees. So particularly USAID. USAID is primarily a contractor staffed, or was a primarily contractor staffed agency. So there were a number of prime contractors for USAID, think like a Chemonics, for instance. So aspirationally, sort of a lot of changes in terms of the workforce. I think it's a little bit unclear to me rhetorically or aspirationally what the direction is for Doge on the real estate footprint. GSA, which is essentially the U.S. government's landlord for its real estate needs. The landlord's the wrong word, I'm sorry. Broker, facilitator, has for a long time been trying to figure out how to rationalize the footprint of owned and leased real estate, right? So that's not new with Doge, but there does seem to be really a new energy to it. So what parts of it are real? I mentioned USAID because I think that is absolutely a real impact. If those jobs do not appear to be coming back. I think it's likely that there are other areas in the federal government where there are going to be significant reductions in the workforce. I think we can see some evidence of this coming out in some of the claims data. Federal government employees don't file for state unemployment. There's a separate system, but we can see some evidence of it there. With respect to what's real in real estate, I'm not sure. I think that's very early. And then the question is, how does it impact us? Thankfully, we don't have a government contracting lending business. So in looking at other banks in the Washington, D.C. area, government contracting, which is really a form of C&I lending, has been a fairly popular business over time, and for somewhat obvious reasons. You know, the businesses were doing business with the federal government, and those appeared to be contracts that were money good. And so that lending business was a fairly popular one. I think that there are components of that business that are in real trouble right now, particularly if you had been lending into the USAID pyramid. Maybe if you're in defense and security, it would be a little bit different. I think that significant lending into office space that is primarily tenanted by GSA, I have some real concerns about that. So the two things that I would say I'm most concerned about generally would be those two, and we don't really do those two things. We have no government contracting lending business, and we have two properties with GSA tenancy, and they're very, I would say, special purpose, and they're in the defense and intelligence as opposed to a Department of Agriculture or education or a kind of general purpose lease. So I think there are going to be real impacts there. I think the next question is, what is the indirect impact on the economy in Washington? Because that's where it's most likely to show up for us in multifamily. And it would be most likely to show up on the demand side, right? So a lower demand for multifamily housing, higher vacancy, potentially reduced rents. I'm not seeing evidence of that yet. In looking at both the data that we see from our borrowers and in looking at the kind of general data that we can get about the market, vacancy remains low, and rent growth remains fairly healthy, and remained healthy actually through December, January, February, which cyclically is not like a great time for month-over-month apartment rents. I mean, it's very, I remember, I think we talked last year, you own some apartments in New York, right? Yeah. I mean, it's not a great time to be raising rents. And so I'm not seeing it there yet, but I'm cautious about what that might look like. One of the reasons that I'm cautious about what that might look like is that I don't know how much of the impact on the workforce will be real, and I don't know to what extent the market may react dynamically and absorb it. So, we regularly advertise for bankers in Washington on both the deposit and loan side, and we often advertise some of our operational roles as well. And I'd say in the last 3 months, we've been getting some resumes from federal government employees who, they look like great folks, they look like they have a strong background, they don't have the subject matter knowledge that we need, but they seem smart, talented, I think they'll land on their feet. And so in thinking about the impact on us, it's not just a question of whether there's some demand that comes out because of DOGE, it's a question of whether the private sector elements of the Washington economy can absorb some degree of labor coming out of government at the margin. My instinct is that they probably can, but without knowing the amplitude of these things, the real size, it's difficult to tell. Yeah.
So I supplement on that a little bit in the sense that there's a great deal of uncertainty. If the reductions are as substantial as indicated, could be some negative impact. On the other hand, this countervailing influence in terms of the return to work mandate, does that bring more people in terms of rental pressure in the city? That's a potential positive. As Patrick indicated, as of right now, it's difficult. I mean, through March, there was still, the rental increases were healthy in March. Metro ridership was up in March over a previous year. So some positive indicators, and it leaves us, I guess, with a level of uncertainty.
I'd probably add that whether this is cynicism or not, people have been talking about making the government more efficient for a very long time. And the government has probably become more efficient in some senses, but in absolute terms, it has continued to grow. And so if I was thinking about measuring the impact of DOGE this year, it's difficult to tell. The uncertainty is pretty high. If we reframe the question, it was, what will the impact be if we go out and measure it 5 years from now? I have a higher degree of certainty. And if we said 7 to 10 years from now, I have a fairly high degree of certainty that that impact will be muted over that time. I wasn't kidding. You took about half the question.
Yes.
I'll alternate a little bit. I'll take one from here, and then let me move back to the room. So this was from Adam Mead. Adam, would you like to read your question? Okay. So this is a good one. As of December 31st, 2024, let me give this a little bit of color. This question from Adam is related to some of the investments that we've made in other banks that, for a variety of reasons, we've now disclosed in our filings. To give you some color for the question I'm about to read. So in Adam's words, as of December 31st, 2024, Chainbridge Bancorp, Patrick speaking, this is a bank in Virginia, disclosed 4 Reg O loans at 7% of capital. Founders Bank disclosed 3 at 19%. and National Capital Bank had one at just under 20%. Just to add for everyone's benefit, a Reg O loan is a loan to an insider of the bank. So Regulation O is a federal regulation that governs how banks lend to insiders. We don't. Adam again. I share Hingham's view of the risks of insider loans, and I'm wondering, A, your thoughts in general of investing in other banks that seek to mitigate, not eliminate these risks, like Hingham, and B, any updates or information you have on these loans that might be useful to Hingham shareholders. I have a couple of thoughts here. So for everyone's benefit, maybe I should have done this at the beginning or the end. Since 1993, we have had a policy that, with the exception of passbook loans or loans that are secured by a deposit account, we don't make loans to insiders of the bank or their affiliates that are covered by Regulation O. Regulation O provides a mechanism for banks to make those loans, and there's a number of different requirements. It's essentially that they be done on an arm's length basis, that the pricing be similar to that which the public receives, and that the loans be approved by an independent board of directors. So there's a way to do it, and we've never done it. Our view, and Adam was stealing some language from us, is that it's best to eliminate some of the risks that are associated with lending to insiders rather than mitigate them through Reg-O. I would say that I would not apply that standard, and we have not applied that standard to some of the banks that we've made investments in. Now, I think one of the things in making equity investments in other companies, and particularly in banks, that we're looking for is an alignment between the owners of the bank, the management team, and the board. And to the extent that it is possible, we're trying to determine whether those are people of integrity. I think that our way has worked well for us. I would not necessarily expect to see it elsewhere. And in fact, I think our way is somewhat unique. And I think if we did that, we probably wouldn't do very much investing. In those instances, so Chainbridge is a bank that was formed by Peter Fitzgerald in McLean, Virginia. It's 17, 18 years old now. It's a fascinating company. National Capital Bank is a bank in Washington. It is, I think, the oldest bank in the district, formed in the district, 1854 or thereabouts. It was formed by the Didden family, who has been involved in the management of the bank since its formation. And then finally Founders, which is a more recent de novo in Washington. In all of those instances, my impression, my belief is that the management, has a significant personal investment in the bank. And there is real economic exposure that they have there that aligns them with other shareholders. Two, in all three instances, so Peter at Chainbridge, Randy Anderson, Jimmy Olipson, the Didden family at National Capital, and then Martin and his team at Founders. I think our impression is that in all three instances, they are people of integrity. And to the extent that they're doing residential loans to insiders, that doesn't impact my view of their integrity, of the degree to which I think that they're doing an outstanding job in some instances running those banks on behalf of owners, and so I'm comfortable with that.
I think as you said that, I don't think I've ever seen another bank that prohibits any loans to outsiders, other than our own. So, as Pat said, we wouldn't be investing in very many banks. Yeah.
Since you're here, do you have any follow-ups on it, Adam?
No, I mean,
I didn't mean to put you on the spot, but
no, I'd love it if more banks were like Hingham in that respect. I think
Yeah.
the risks are heightened. And I guess maybe the follow-up is, do you have any insight into those loans? And
they're primarily residential. Yeah. Yeah, I think Chainbridge obviously is relatively new. Founders is much younger. National Capital has been around for a long time. One of the things that's difficult in thinking about that tension is it is oftentimes the case that those are good loans, right? I mean, they're to individuals that have good, strong balance sheets. They may be residential owner-occupant loans. They may be low leverage. And when you think about a bank that is in a de novo phase, or Chainbridge, which is relatively young, I mean, these are banks that have networks of relationships in their communities, whether it's the folks that are serving on the board, whether it's the staff, whether it's the principals. And I can appreciate the tension that they face in looking to eliminate or mitigate those risks. In looking to eliminate or mitigate those risks, thank you, Kayla, versus trying to make good loans and grow the bank and kind of get the business going. So I think there is a dynamic tension there. I don't think it's a choice for everyone.
Residential loans as a percentage of the entire loan portfolio has obviously come down the last decade or so. Long term, call it 5 years out, is it feasible that residential would be less than 5% of the total portfolio?
Kayla, do you think people could hear that, or should I repeat it? That was good? Okay, good. I think it is somewhat unlikely that it would be below 5%. So I can kind of start with the easy version of the question. I think that it's likely that over time, it will be a smaller portion of the balance sheet in terms of residential owner-occupant lending. And I think there are some structural reasons why that's the case. When we lend to you on your primary home, you have a great deal of success. 10 years from now, you buy a second house. We finance your second house. This is a beach house. It's out in the Outer Banks. 10 years later, you're still doing really well. You've decided that you don't like spending as much time at the beach, and you want to buy a house up in the mountains in Boone, or Blowing Rock, or whatever. Okay. You're now probably in like the top 1% of residential owner-occupant owners in the country, right? Like you now own 3 homes for yourself. Most people probably own like 0.7. Like if we think about home ownership, like people they own 1 house. They don't own 2, they don't own 3. They might move, but the net exposure won't change for us. We'll finance the first house, you'll sell it, we'll finance the second house. Whereas if you look at the apartment building business, it's just the dynamics are very different. Like you might buy a 3-family, you might live in 1 unit, and then you'll move out and you'll buy a second one, and now you own 2 buildings, 6 units, and now you buy a 3rd building, and we can continue to do more and more and more business with you. And so in the context that we were talking about earlier, where like a lot of the business comes from, it's existing customers. The dynamic is that we tend to do more and more business with a customer over time, and that grows. And if we have a great relationship, we finance that customer's house, but we don't do it again and again and again. And so structurally over time, the balance sheet does change. I think there are some other drivers, which is to say that the residential owner-occupant mortgage business has changed in the last 10 to 15 years in ways that make it somewhat less attractive, in part because prior to Dodd-Frank, we could do some things for customers that are much more difficult to do now in terms of non-conforming lending. And so the number of areas where we're doing something where we can be safe because we can push leverage down, where we can be compensated appropriately in terms of price, and we can solve a real problem for the customer, right? Like the customer feels like, I wanted to do this thing, I couldn't get my existing bank to do it, I couldn't walk into a Bank of America to do it, I certainly couldn't, go online and get Rocket Mortgage to do it. That space has gotten smaller over time, and that's the space that we'd really like to operate in because it's a better business. And so I think that that's likely to trend down over time, but in absolute numbers, I would expect the portfolio to grow over time. Because to the extent that in both the deposit side of the balance sheet with our commercial real estate borrowers, we're looking to deepen those relationships, then we should be financing more of their primary and secondary residences. That won't affect balance sheet composition, but it does say something about the growth of the portfolio. Any follow-up on that, or is that
So
kind of
just long term, do you expect it to shake out at 78% of the total loans, or do you have an internal goal for where you want to be?
I'd say it's somewhere in that neighborhood. But just summarize it, to the extent that it's a commodity business, it's not one that holds attractive returns for us.
That's fair.
About the shorter repricing question.
Well, I don't want to give Adam all the questions. No, fine, we'll just work through the list. Yeah, so again, from Adam Mead, it's been about a year since you instituted shorter repricing. Can you talk about your experience, how borrowers have reacted, any competitors following suit? So what I think Adam is making reference to, and if I'm wrong and putting words in your mouth, Adam, correct me, is historically, we, along with a lot of other participants in the multifamily market, had made multifamily loans that were fixed for 5 years, adjusted at a margin, typically to the Federal Home Loan Bank, for an additional 5 years. And those loans might have had 2, 3, 4, 5-year legs. And so the repricing event came every 5 years. There were some things about that turned out to be not so attractive. In particular, at that first repricing, you really only get one bite at the apple. There were some other folks that were writing 5-1 structures, so fixed for 5 and then adjusting every year. And about a year ago, actually I think it was a little bit more than that, we moved to a 5-1 structure where for our multifamily loans, fixed for 5 and then floating annually. We really have not seen very much borrower reaction at all. And I think it reflects the fact that to the extent that no one really will accept a prepayment penalty beginning in the first day of the 6th year, because we could do that, right? Like we could structure it differently with meaningful prepayment penalties that reset each time the rate resets. To the extent that no one's willing to accept that, and we say, okay, we're not willing to give you the new 5-year rate fix, there really does not seem to have been a lot of borrower reaction at all. I think everyone has taken it and in the current environment may assume that they will have the option to refinance in that period at potentially lower rates anyways, without expressing my thoughts on whether that's correct or not. So it may be that borrowers aren't sensitive to it because they believe that they're not giving up very much of value. Not totally sure, but I think that's the case.
I'd also say we have some questions in terms of what we're doing in terms of reducing sensitivity to interest rate changes in the future. That there's a number of things that Pat will comment on, but I think that one particular change in the longer term is going to be the most significant change we possibly could have made. So
I would agree.
It's not impactful today, it's not impactful next year, but over time, that the portfolio, primarily of commercial real estate loans, when that is repricing every year, that should give us a great deal more control over future rate changes. Yes, sir.
What's the percentage that borrowers that actually extend their loan after the initial 5 years? Because as a borrower myself, most of the time I refinance, I don't extend.
I don't have an exact number on that, but it's substantial.
And use the option.
Pardon me?
Well, so-
Accept the option.
Well, so I think the critical thing to note here, and this is a little bit of a difference, is that typically the structure that we will use is not actually an option that you're required to exercise. So the loan wouldn't be a 5-year loan with a 5-year maturity and an option to extend the maturity. It would be a 10 or a 15-year loan with an initial fixed rate period for 5, and then the repricing occurs automatically as defined in the note.
And they don't have an option to get out of the loan?
Oh, they do. I mean, that in particular is the issue. So typically we use what are referred to as step-down prepays. So 4321, 5321.
The grace period, right?
There's not a maturity. So they can actually prepay once the prepayment penalty has run off. So in that 5th year, so let's say it's a 5-1 and it's a 10-year note. There's a 5-year period where it's fixed. At the end of the 5th year, it resets for the 6th year at, let's say, the 1-year home loan bank plus 300. And it stays at that rate for 1 year. And then at the end of the 6th year, it resets for the 7th at whatever the then 1 year is plus 300. But you don't need to pay a fee to extend with us. You don't need to exercise an option. All of that is defined up front, as opposed to like a 5-year bullet where it matures at 5, and there's an option in the loan documents where maybe you need to, I don't know, you need to do something to exercise that option. You need to give us notice, maybe you need to pay the loan down, or I don't know, it's some other form of
In that
consideration.
5th year, there's a 2-month grace period where there's no 1%, right?
Do people pay off in that year?
No, I'm saying, do you have that in your loan?
Oh yeah, we're typically open in the 5th year. Yeah, so I would say that most of the sort of garden variety structure would be a 5-year fixed rate period with a 4321 or 3221 in the 1, 2, 3, 4, and it's typically open in the 5th year. I would say that we don't see, and I don't know that I would be in a position to give you a good hard data on this, but I don't know that we see a huge amount of payoffs in that year. So I think when we see payoffs, it's typically sale driven or it's refinance driven because they're acquiring something else. It's not that activity is getting concentrated like in the open window, because if they come early and pay a point to get out, they're doing that because the economics makes sense in some other way for them.
And obviously, if rates are moved against us, their inclination is not to pay it off by refinancing. They want to hold on to that beneficial rate, and the one-year situation will allow us to address that properly.
Yeah, the real issue that the change addressed is that if you happen to reset for a new 5-year leg at a relatively low point in rates, then borrower, I shouldn't say you, I'm sorry, but like the borrower has the advantage of that lower rate and we have no prepayment protection. Now we may not want it if the rate's low enough, but on the other hand, if it was sort of a kind of a middling curve environment, we may want that because there is a new 5-year fix and we would expect some kind of protection back. To the extent that nobody wants to do that, we change the structure to a 5-1. And it seems to have worked fairly well. We'll really know probably about 3 years from now, 2.5 years from now, because we'll start to see those come in and we'll have the ability to see how heavily do we negotiate those? Do people look to take them from floating 1-year adjustables back to fixed? What kind of consideration do we want for that? What can we get? That's hard to know. But so far, to your question, Adam, there's been no pushback on that. That's a good, so Tim, I apologize. Tim Zengi. So his question, what are the realistic goals for the liability side of the balance sheet over the long term in terms of the mix of the different funding sources? In other words, what are the different factors that will determine the mix between non-certificate deposits, Federal Home Loan Bank borrowings, certificate deposits, etc., over the next 10 years, and what are the bank's goals in that regard? So I think here the important thing to think about is that we're looking at the lowest all-in cost to fund the balance sheet through the cycle. And that all-in cost has an interest component, it has a non-interest component. The interest costs are fairly obvious, which is to say time deposits are typically very expensive, higher rate money markets are somewhat less expensive, but also more expensive. Checking accounts with respect to interest, they don't pay interest, so obviously very attractive. And then the wholesale sources, broker deposits, listing services, the Federal Home Loan Bank, tend to be the most expensive from an interest perspective. The non-interest costs are somewhat more difficult to ascertain. So these are our expenses in acquiring and servicing different kinds of funding. There's some areas in which it's pretty obvious. So the Federal Home Loan Bank essentially has no non-interest cost. We don't market to them. We don't have relationship managers that are responsible for servicing that funding. Historically, we have funded a very significant portion of the balance sheet with some forms of wholesale funding, and that's typically been the Home Loan Bank. There's a reason for that. It's very inexpensive from a non-interest perspective. It is stable in the sense that we can borrow at different duration points. It's open every day. It's open in size. We get excellent availability on our multifamily collateral there. The Federal Home Loan Bank's mission in terms of housing, and in particular affordable housing, is one that aligns with the kind of things that we lend on. So that's historically always been an important piece of the balance sheet. I think it'll continue to be an important piece of the balance sheet in terms of how we fund the liability side. The call it deposit side of liability funding. If we were to go back 15 or 20 years ago, it is, I suppose, explicit in the name of the bank, Hingham Institution for Savings. The balance sheet had more of a savings bank composition to it, which is to say, more time deposits, more money markets, typically at higher rates. If we were to go back even further, you would find a time when savings banks were not allowed to offer demand accounts, checking accounts. And so this historical kind of dichotomy between trust companies or commercial banks and savings banks is one in which savings banks tended to have higher cost funding and did not tend to have significant non-interest funding, if any at all. That's been something that we've been working to change. I think our view has been that there are ways of doing that that might not necessarily involve the trade-off that I've been talking about in terms of cost on the expense side and cost on the interest side. So 20 years ago, if you wanted more kind of retail customers, you needed to open a branch. So you had a physical investment, you had staff, you probably had significant marketing. In looking at the profile of how branches develop, typically the first couple of years are very expensive. You tend to have very low growth in checking deposits. It tends to be promotional CDs. It tends to be more expensive money markets. And that really was the only thing on the table. I think that has changed. And it's changed because the potential customer for the bank, the potential market that we're talking about when we talk about customers that are well served either by our retail banking group or by our specialized deposit group is very, very different today than it was 20 years ago. And what that means is that we should be able to fund over time, to Tim's question, because he was asking about goals, we should be able to fund a greater and greater portion of the balance sheet with a funding mix that is both less expensive from an interest perspective and less expensive from a non-interest expense perspective or cost perspective. We should be able to do more of that because the audience of customers is broader. It's a national audience. It is not just the folks that are in close proximity to our office here in Hingham. And it's an office, it's an audience that I would say is increasingly poorly served. There are fewer and fewer alternatives where there is a service model that is not fee-driven, that for larger and more complex customers that have service needs, that serves them really well. There have been significant changes in all three of the markets, particularly here in Boston in the last several years. And those clients, they want their bankers to help save them time. Particularly those more complex customers. To the extent that we can do that, and our relationship managers and our service teams can serve more and more of those customers, and those customers are on average somewhat larger, then I think a more meaningful portion of the balance sheet should be funded in lower cost MMDA and in checking. Now, I can say with great certainty that we will never get to the point that Chainbridge is at, where nearly 90% of $1 billion plus balance sheet is in checking accounts. They've done an extraordinary job. It's a very niche business. So I think that would be an unrealistic goal. We don't have that. But if we were at 15 or 16% now, and I was looking 10 years into the future, I would expect that number to be much higher. Some of that depends on the growth in the total balance sheet. but I don't think it would be unreasonable to be funding closer to 25 to 30 to 35% of the balance sheet in checking over a longer period of time. And, I think that could be a stretch in certain respects, but I think that would be a reasonable goal, and it reflects the breakdown in norms around geographic proximity that I talked about. It reflects, I think, our awareness, our increasing awareness of some more specialized verticals in the deposit area where we can provide something in terms of service that others might not. And I think maybe an increasing awareness that we don't need to be price takers. We don't need to be price takers. Kayla, if you need me to be louder, you can speak up too.
A little louder.
Okay. That we don't need to be price takers in the way that we thought in that area. That there are some things that we can do there that will build meaningful non-interest bearing deposits. And I think we're doing some of the work on that now.
So I would say, in response to another question that is related, what are the biggest medium and long-term threats to your ability to grow core deposits significantly? It is the people, okay? So years ago, it was always, well, the bank's not convenient to me, I need a branch here. And that is not the case any longer. It's really the quality of the relationship manager, it's the quality of the cash management services. We've got some great people in that area, and we continue to look for additional folks. And the geographic boundaries coming down. We have a school in Alaska that we provide all of their banking services for. The payroll, et cetera, a school in Alaska. I mean, it's remarkable how an entity like that is not bound by geography. They don't seem to have any concern at all that we're located out here on the East Coast, and they're out there in Alaska. So there's tremendous opportunity there, but our ability to grow is really dictated by the quality of the people.
And that particular customer came to us from a national bank. For folks that know anything about the Alaska banking market, I'm sure we have a lot of them here. It's fairly consolidated. Wells Fargo has a significant piece of the market. And they had been they were across the street from their existing bank. So it wasn't physical proximity. It was service. And that service is really about the people that were banking them. The question of how do we find those customers? How do we talk to them about what we're doing? How do we help them see there is an alternative to the way that they're banking now is something that we spend quite a bit of time thinking about and working on. Because it's not the case that we're just looking at customers that are geographically proximate to us. And it is also not the case that we're looking at pure digital delivery to those customers. So there was another question that came from Kobe Kochabi. Gunnar, did I pronounce that correctly?
That's how I pronounce it.
Oh, okay. Well, if I got it wrong, I can blame you. What steps is the bank taking to remain competitive in an increasingly digital banking environment, especially as fintech companies and larger institutions enter the market? And I want to pair these questions together because I don't think it's the case that that broader audience is a potential market for us because we're delivering in a purely digital way to them. So it's not the case that we can serve that client in Alaska because we have a website and a business online banking presence and an app that has certain functionality. I think that those things are probably necessary, but they're not sufficient, and they're probably not the thing that really drives whether the customer makes choice to move, what really drives that decision is the experience that they have with our people, whether it's the relationship managers in SDG or whether it's the cash management specialists that support them. I apologize to Kobe a little bit, but I think that the question of remaining competitive in an increasingly digital banking environment is really one about pairing the right people with digital solutions that work for the customers. I think there are some things where the solution is somewhat more specialized. So for instance, we have some solutions when it comes to escrow management, principally for security deposits for tenants, but we have some other customers that use it for some other specialized purposes, where there really is like a unique customer problem and a particular digital solution to that problem that we're delivering. And I do think that matters there. But I think the bigger thing is the way in which the initial conversations, the way in which the service interactions occur, because that's really what will get us in the door over time. I think figuring out how to deliver digitally, I think it's necessary, but I don't think it's sufficient, to Kobe's question. I think there is a different, probably we'd be here for a lot longer question here, which is historically people have done their banking with banks. To the extent that banking functionality is embedded in the software that companies use to run their businesses, and to the extent that that may change the way in which potential customers interact with us. So the examples that I often use in the apartment business, whether it's Yardi or Buildium or some of the other higher end property management software, in which a lot of the rent collection, the payments, the accounting is built into the software that's running the business themselves. Our clients are not coming to our online banking tools. They're kind of interacting with us indirectly using those products. And I think that's a very interesting question in terms of what that means for the business over time. My sense is that people layer, the quality of the relationship managers and the cash management specialists, is probably a significant defense to that kind of disruption. Because things are going to go wrong at the integration layer, and when they do go wrong, I think the quality of the people that can address those issues is going to be really important.
Anything from the floor? Any questions from the floor?
Yeah. I've noticed recently, by me going, I guess you could call it shopping, I guess, that banks are offering for multifamily better rates by bringing in deposits into the institution. Whether it's 10% or 15% of the loan amount. Is that something, I just want to know your thoughts about that.
Yeah. Over time, we've focused more and more on trying to do business with customers in the multifamily market where we are one of, if not their primary operating bank. And so historically, we'd always required a deposit relationship of some kind. And then we started to focus a little bit more, and we wanted to see that it was actually being used. Like we saw rent collection, we saw expenses being paid. And we did that for a couple of different reasons. One, we did it because the deposit funding was valuable to us. Two, we did it because we could see, like, there's 15 units in this building, are there 15 rents coming in? And we could build some P&L on buildings using the deposit accounts that was of some value to us. Say that we kind of moved from some relationship to an operating relationship, and in the last year, 2 years, we've started building in some minimum balances, and they're typically a function of the gross rent on the building. And the thinking is that if the gross rent on this building is X in a given month, we're looking for some multiple of that, so a couple of months. Now, if we did all our math backwards and figured out, like, that's not 15% loan balance. That's usually somewhere in the low single to mid single digits. The funding is valuable. It's never really going to fund the business. Like, there's just not enough liquidity in the universe of multifamily borrowers to fund what we're doing. So it helps a little bit on the margin. I'd say it's probably a little bit more of a credit tool, in the sense that if somebody doesn't keep a couple of months of gross in the account, they might be running things a little tighter than we would want them to. And in those discussions, we learn something about borrowers. Like, you can't keep 2 months of gross in your bank account, like, and it's a 3 or 4 family, and that HVAC system's 15 years old, or you're gonna find out real quick you should keep a little more cash in that
But I
business.
think banks today are using that minimum requirement to bring down enticing rates, I guess we would call it, where they offer a more better rate
Yep.
than other institutions.
I think our view has been, with the exception of the agencies, on multifamily, we're typically very competitive. So from a rate perspective, we're probably already where that enticing rate is, if it's low leverage and it's in the box that we want.
I will say, though, that at loan committee, there's a great deal of scrutiny placed on those balance sheets and why the deposits aren't with us. It's a frequently asked question. I'm sure the lenders would tell you that. There's always an explanation look for. Why is that money over at Bank of America, or it should be here? Yeah.
Let's see.
We got a hard stop today at 4 o'clock.
Oh my, okay, I gotta move quickly, I've been yapping. Christian Olafson. Christian, I think, contributed 6 or 7 of 14 questions, so I should help him out here. In the chairman's and president's letter in the 2024 annual report, you wrote that we are making, quote, we are making certain changes to our model that will reduce our sensitivity to outlier inversions. Could you please elaborate on this? So I think there's a number of different things that are going on here. One, there has been some gradual extension of our wholesale liabilities, both in our brokered book and at the Home Loan Bank. Certainly not out 3 or 4 or 5 years, but some extension from 6 to 12 to 18 to 24 months, which is very helpful. The other thing that we've been looking at this year, and I think I talked about it a little bit last year, historically, we have not used derivatives either at the balance sheet level or in customer transactions. So in a customer transaction, what would be referred to as a back-to-back or a mirror swap, where at the outset of the loan, we essentially fix the margin in place on that loan. At the balance sheet level, we're talking about doing things that adjust the sensitivity of the balance sheet to particular outcomes. Historically, we've not done either one of those two things. In looking at some banks that are similar to ourselves, that navigated this period particularly well. So there's a really well-run bank in California called River City. It's principally a multifamily lender. There was a really effective use of interest rate caps, which are essentially one-sided derivatives that the bank could purchase, and if the reference rate, short-term interest rates, were to rise above that cap, that begins making payments to us, or counterparty does. And so that's been something that we've been thinking about as a relatively efficient relatively low cost, relatively low risk, depending on the nature of the counterparty, and I think that's something that we could manage, way to address the risk that we've seen in the last 2 years of what is a relatively infrequent inversion, but they do happen, and if they happen in sufficient amplitude, they can be very painful to us. So to Christian's question, that's sort of one of the things that we've been thinking about. What we've been doing has really been the extension of some of the wholesale liabilities. And I think to some extent, the focus on non-interest bearing deposits, which we've been growing over the last year. But Christian had a couple other questions, and I'll address those in sequence. So the one question, if the Fed funds rate and the entire Treasury curve remain the same for the next year, would you expect your net interest margin to increase? I think this is probably a fair question. We have historically not provided any guidance with respect to either the balance sheet or the income statement. Without sort of speaking in specifics, I think it's fair to say that if we think about where we are originating new loans, where we think about how the loan portfolio is repricing, so we can see when loans reprice and we have some expectation of what they should reprice to, that we have seen over the last year, and I think we expect to continue to see, a fairly steady climb in the yield on earning assets, driven primarily by repricing and to somewhat lesser extent by new loans. And then on the liability side, we can see as time deposits come back to us, what those CDs are currently priced at, what we would replace them at today for our borrowings or other wholesale funding. We know when those mature, we have some sense of where they would reprice today. That on both sides of the net interest margin, both the yield on earning assets and our liability costs, even if nothing were to happen this year, we would be benefiting in both dimensions. I'd prefer to not say exactly how much, because we really don't know. It is an imprecise art to model this, but I think we would have pretty strong confidence that even if nothing were to change, we have a tailwind at our back in both respects. I think I addressed both of Robin Hollenstein's questions. With the other Doge questions that we touched on.
Patrick,
Yep.
speak a little bit more about what's changed to make you more strongly consider a stock buyback, and what would the logistics of that look like if you were to undergo such a transaction?
Could you say that just a little bit louder, Tyler?
Yeah, absolutely. So what's changed to make you more strongly consider a stock buyback this year, and then what would the logistics look like if you were to do that?
So I think probably I wouldn't say that the thinking has changed this year. I would say that it is something that is more salient to us and has become more salient to me probably starting a year ago, maybe a little bit earlier. And maybe a little bit earlier than that, actually. There's a couple of drivers there. And I want to spare everyone the roughly 45 minutes we spent talking about this last year, but I think it's worth going through it again. What is the expected return on the deployment of capital inside the business organically, right? So if those returns don't appear to be adequate, then I think you need to think about what you're going to do, right? Is a dividend appropriate? Is repurchase appropriate? In thinking about repurchase, there is a great sensitivity to price, right? I think that is a significant driver. And really, those two variables are the most significant things. What is the expected return over some reasonable period of time by investing organically in the business, which for us is growing the balance sheet, levered capital? And what is the price that you would pay in a repurchase relative to those prospective returns? If we were to look over long periods of time, I would say that did not make sense because the prospective returns were attractive and the price that we would pay in a repurchase was too high. I would say that I never want to comment on prospective returns, so I'm not going to talk about how I think about that right now. But I would say that in recent years, the price has been potentially more attractive. Again, we haven't done it. It's not at the top of the list, but it has been a conversation that we've had in a way that we really never had it before. In terms of the logistics, the bank does not have a holding company, which means that in order to repurchase stock, we need to do and think about a couple of things. The first thing that we would need to do is we would need to apply to the FDIC for permission to repurchase stock. That is not something that you need to do in a holding company, because in a holding company structure, typically the bank would dividend capital up to the holding company, and a holding company would make those repurchases, and that's not subject to FDIC review. So that's something that we would need to look for approval for. I would say that that's something that we are very familiar with. At that point, it really is a question of how one could best execute a buyback, what the size might look like. Historically, the stock has been fairly illiquid, which makes that challenging. I'm speaking in a very long time period. Recently, that has not been the case, so I think the logistics are somewhat easier now than they would have been, so I think we would need to make that application. I think in terms of execution and liquidity, it's probably easier now than it would have been 20 years ago. There are some tax implications. So there's a relatively new tax on share repurchase that would apply. And there is a tax implication for us because we lack a holding company that effectively imposes a penalty on roughly the first $2 million of stock that we would repurchase. But as we've grown, that fixed dollar penalty stays the same. So if we were to go back 15 or 20 years, that $2 million penalty in terms of repurchases would have been the same in '96 as it is now. And so as you think about the capital base of the bank growing over time, the impact of that penalty becomes smaller and smaller and smaller. So it's probably one reason why I would think about it maybe today in a way that I wouldn't 10 or 15 years ago.
I think we have time for one more question, either one that you've got, Pat, that was submitted, or one from the floor. Anything from the floor? One more.
Can we get an update on San Francisco purchasing the branch out there, and then any reduction in the next couple of years on any branches here in Massachusetts?
I got to update you that Patrick's looking constantly out there.
Yeah. I have only news of failure. We've been looking. I would say, have been looking more in the last year than in the year before that. So if we go back to this meeting last year, Phil Denici, who works in our specialized deposit group, had been with us for probably 2 months. He was our only on-the-ground person out in San Francisco. Since then, we've added 2 folks in the cash management team, Jackie and Stasi, Brian Harvey, who joined our commercial real estate group. And we've been having a lot of conversations with building owners in a couple of different areas in the city. I would say that the office market in San Francisco really is a tale of 2 cities. So larger institutional buildings, still a ton of distress, right? So if you're looking at something that's 150,000, 200,000 square feet, 10 stories, 15 stories, the towers, there's a lot of vacancy, and there's effectively no incremental value above like the 4th or the 5th floor. That isn't true in the smaller owner-occupant space. So let's say sub 10,000 square feet in attractive areas of the city. And we don't need that much space. If we did that, we would carve pieces up like we've done on Nantucket and find other uses for them. In the sort of most attractive areas in the city, so we've been looking in Jackson Square in particular, in the North Financial District. We've looked at some other things up in Pacific Heights. We've looked in Cow Hollow. In that market's pretty healthy. And so we really haven't been able to find someone who would part with something that we liked. And to the extent that we're going to buy it and we're going to hold on to it, I want to make sure that it's something that works for us over a long period of time. You know, I don't want to rush into it. The leased space that we have is fine. I think it's probably likely that at some point in the next year we'll expand in a somewhat larger space given the team. But in terms of buying something, I'd rather do nothing than do the wrong thing there. I would also say that I have some sensitivity to the amount of work involved. So, you know, if we're going to buy it, we're going to own it for a long time. We want it to be something that reflects the bank that our staff enjoy working in, that our clients enjoy visiting. That requires some work. And construction projects increase in difficulty exponentially as you move physically away from them. And so, to the extent that we could find something that did not require the level of work that we put into Washington or Nantucket or this building when we did it 15 years ago, I prefer to do that. From sort of a business perspective, I think we had a really great year in San Francisco on the deposit side last year. I was thinking about making Phil stand up so that we could look at him. But we had a really strong year. I think like great growth in core relationships. Really pleased with the folks that we have on the team there. Some of the folks in the cash management team are supporting East Coast clients that are out in San Francisco. I think they've done a great job. Brian's relatively new. You know, Brian joined us at the beginning of this year. Last year was a very slow year in San Francisco, I think, for us, and I think for everyone, really. I am somewhat more hopeful that we'll see a little bit more activity there this year. I have 2 minutes to talk. One thing that we talked about last year was the extent to which the environment in San Francisco was changing. I would say the elections in San Francisco in the fall, and Phil, you correct me if I'm wrong about this, but I think the environment in the city, particularly in the business community, but I think amongst others, I think the environment's very different. I think there's a great deal more optimism that what Daniel Lurie has been doing is changing the feel of downtown San Francisco in a way that I think we always anticipated would occur. I couldn't have given you a bet about timing. That we always believed that the fundamentals were there. But it does seem like they're making real and material progress. And I think we see some evidence of that in the hard data. For the first time in a number of years, we've seen much stronger rent growth in San Francisco on the multifamily side. And in some of the office market, which is not something we do a lot of, but we can see some of it, there has been in smaller, high-quality buildings, kind of like the ones that I'm talking about, maybe a little bit larger, more demand in a way that might not have existed a year ago or 2 years ago.
Well, the hour having arrived, I want to thank you, Patrick, and thank everyone for joining us this afternoon. It's always something that Patrick and I enjoy, listening to questions from shareholders and getting some feedback. So thank you all, and